Hi guys, this is Sue Ellen at Abbey Home Loans. How are you? Thanks for coming back to go over this detailed closing cost worksheet. Now, the reason I decided to do this video was one of my borrowers called me not long ago, and we were in a 45-day escrow. We were like 5 days out ready to close. And she called and she said, Sue Ellen, I don't remember what you told us about how our loan amount got to be this dollar amount. And then there was another fee. She had these worksheets, but there was another fee that she was asking me about. And I felt bad. She goes, I've been going to ask you, but I just didn't want to have to ask again because I know you explained it to us before. And I thought, how sad. I don't want someone to have to be self-conscious to ask questions. And you have to understand, typically, a homeowner only buys 1 or 2 homes, and they are only going through the loan process a handful of times in their lifetime. So remembering all this stuff is not something they really need to do, but they do need to understand it to close, okay? So I decided to do this video so that I could give to my borrowers, and that way if they want to go back 2 or 3 times and go over it, it will help them to understand what they're paying for and how much money they're bringing in to close. So with that, let's go down this list. I'm going to go over it slowly and do it in detail so you understand it. I know it's going to take a few minutes, but if you can bear with us, we'll get through it, and I think you'll get some good information at the end. Okay, so this is an FHA purchase for $400,000. These are my borrowers, Mickey and Minnie Mouse. Nice couple, just by the way. Anyway, our estimated close date was July 16th, and we took the application on June the 2nd. So we were in a 45-day escrow. Okay, the loan amount is $392,755. That was the question that my borrower called me about. Okay, the purchase price of $400,000 less the 3.5% down that FHA requires, $14,000 down, plus the upfront mortgage insurance premium, which it's added to the loan amount. Okay, there's both an upfront mortgage insurance and a monthly premium that you pay on FHA loans. So this $67.55 that got added to the loan amount was what was making it where she didn't understand, because it's listed here in this list of fees, but it's not coming out of pocket, it's getting added to the loan amount. Excuse me. Okay, so we have origination fees. There's a processing and an underwriting fee that's going to the lender. Then an appraisal fee of $450. Now, I'm on the Central Coast of California, and that's a standard fee for a single-family residence in my area. Appraisal fees can be a little higher or a little lower depending on where you're at. Then the credit report fee. Remember, we pulled credit when we first started the loan, so I didn't charge you up front, but now I'm going to have you cover the fee at the closing, okay? Then your upfront mortgage insurance premium that we already discussed. Now the next 2 items are title and escrow fees, okay? Escrow is the third-party entity that's handling our documents, doing our closing, right? And in my area in California, it's typical for the buyer and seller to split closing escrow fees. So in this scenario, the buyer's portion of escrow is going to be $1,050. Okay, that includes like the notary fee that we have when we at closing. It's an accumulation of items that are covered, but that's the buyer's portion of these fees. Then you'll notice there's a lender's title policy, and right under it there's an owner's title policy. Title insurance is bought by the owner for the borrower. See, this is a seller fee. They are buying a title policy to ensure that when you get that property, it is free of any encumbrances that the seller might have had. The property taxes are paid up to date. There's no liens on it. There's no assessments that have been, unpaid. The title policy is ensuring that they have checked back through the records, they have audited the file, and they are ensuring that they've covered everything and made the seller pay everything to get it clear, so that when you get the property, you're starting out fresh. That's what the seller's paying for. Now you're paying for a title policy, which is a different kind of policy, and that is for the lender, and it is to ensure the lender that through the life of the loan, anything that affects that title, the deed on that property, is going to be reported to them by the title company. So basically it's a monitoring service for the life of the loan. And so the lender requires it if property taxes don't get paid, if you add somebody to title, if you try to take somebody off title, any of those things will be alerted by the title company to the lender. Okay, so those fees we've covered. Now then, after we get done, just as we close, they're going to record your deed and make sure that public records show that you're the owner of the property. So the county charges us to record those documents. And I've used $100 as an estimate, and that's a good estimate, somewhere between like 80 and 100 on a typical FHA loan. Next fee is the county transfer tax. Again, this is the second fee on here that is a seller fee. Think of transfer tax as sales tax. The seller has to pay this fee based on the dollar amount of the purchase price, and it is to the county for the county to transfer title and property tax bills and those kind of things from the seller to the buyer. Those a seller fee though. That is the end of our non-recurring closing costs. Non-recurring meaning they are one-time fees that happen to get your loan done, to get you into your house, and then you're not going to have to pay any of those again. Now the next section of fees we refer to as recurring closing costs. These are items that are going to be paid over and over every month throughout the life of your loan. Okay, and the ones we pay here, we're prepaying certain items to get you on track and get you into your house. So the lender requires, of course, homeowners insurance to be on the property. We, down here at the bottom, this is you're going to tell me who your homeowners insurance is going to be with. You're going to give me the agent's name and number and a copy of the quote that they gave you telling you how much your insurance premium is going to be, your annual premium. Then I'm going to contact that agent and coordinate with them to make sure that the lender's name is on the policy, that we have the documents that we need, and that the policy takes effect as of the date we close escrow, and that you're covered. Okay, so we're going to pay that premium up front in escrow, and then we're going to put 2 months into your what we'll refer to as your escrow or impound account. Okay, with an FHA loan, it's required that you pay your taxes and insurance in your payment every month, and then the lender pays out the renewal premium on your property tax, on your homeowner's insurance, and the annual bills that come in on your property taxes. With a July 16th close date, that means that these 15 days of interest are going to be from the close date till the end of the month, and that's your August 1st house payment. You're going to feel like you missed a house payment, but we're really making it in escrow. Okay, the first time you write a check will be September. So in this impound account, we're putting 2 months of your homeowner's insurance, so that a year from now they will be able to pay your premium again when it comes due. And we're putting, because your first house payment is September, we're going to put 7 months worth of property taxes in this account so that property taxes can be paid November 1st when they're due. Property taxes are always divided into 2 payments, 2 bills per year. The first one is November 1st, and that's for the taxes due for January through June. And then again on March 1st, you pay the taxes for July through December. Okay, so each of those bills are for 6 months of property taxes, but they're only 4 months apart. So we have to front load this account, or we're not going to have enough money to pay all the property taxes by March 1st. Okay, so based on what month you're closing escrow, that tells us how many months we have to put in there so that our account is right and we can get those 2 bills paid as they come in. In this case, we're putting in 7 months of property taxes. Okay, that's all the closing costs. So now let's go down. Here's your summary. It's a $400,000 purchase. Remember, our loan amount was $392,755. Your prepaid items, all those reserves and recurring closing costs, come to $4,285.28. The closing costs, excluding the upfront mortgage insurance that was added to your loan amount, are $5,377. Now, of that, remember there were two fees. They totaled $1,762. That were the seller fees we included on there. So the seller's crediting you back that on this side. So here, $5,377 less the seller's fees. You have to pay $3,615. So at the close of escrow, the total amount that you're coming into escrow with to close this loan is $21,900.28. Okay, that is your $14,000 down payment, the upfront recurring fees that we have to put in, $4,285.28, and your portion of the closing costs, $3,615, for a total of $21,928. Now, remember, you might have put money into, on your purchase contract, you put money into escrow to open escrow, maybe $1,000, maybe $3,000, maybe $5,000, I don't know, whatever check you wrote to escrow that got deposited into that account up front, that is, you're going to deduct that from this total. You already have some of your money in escrow, okay? And remember, we also talked about in another video ways to pay closing costs if you don't have enough money. You can negotiate with the seller up front to pay closing costs as part of your negotiations, or you can talk to me about it and we'll take the interest rate up a little and get you a lender credit to cover some or all of these closing costs. So we have, some workarounds. We discussed that in a different video, so we're not really going to go down that road right now. Then here's your estimated monthly payment. Principal and interest is $1,875. 1/12 of your homeowner's insurance is $51. 1/12 of your taxes is $416.67, and then your monthly mortgage insurance premium is $434.25. That goes to HUD. So the total amount of the payment you're going to pay to your the lender sends that to HUD. You don't. The total amount you're going to pay to the lender, your monthly mortgage statement, is going to be $2,776.99. Okay, $2,776.99. I hope this helps. I just want you to understand this so you don't feel like you're going in cold or you're signing stuff and you really don't know what it is, or somebody like me talked too fast and you didn't catch it the first time. I hope this helps. If you have any questions, shoot us an email at Abby Home Loans. You can send it to suellen@abbyhomeloans.com, or give us a call and we'll be happy to go over it with you. Okay? I hope you have a great day. I hope that you find this information to be valuable, and then I'll talk to you soon. Come back. Bye-bye.